In a previous video, Why Dividends Matter, I look at the importance of income and dividends to an investor's long-term returns from stock market investing. In this video, I want to pose a question, which is, should you be buying into stocks with high yields without doing some safety checks first? And clearly the answer's got to be no. The biggest dividend payers in the market can sometimes disappoint, and it can happen suddenly and unexpectedly. BP back in 2010 with the Deepwater disaster, Tesco, and more recently, for example. So, really important not just to look for yield, but also to do your safety checks and your homework. Doing these checks won't guarantee that you don't suffer a disappointment if a dividend is cut, but it reduces the overall risk, and that's the name of the game. So, what we're doing here is saying dividends are discretionary. Remember that. Managers decide each year what dividend they're going to allocate to shareholders. It is within their rights as managers to cut those dividends to conserve cash, even down to zero, all right? Now, as an investor, what can you do? You can't do anything about that, but you can test the robustness of a yield and a dividend, all right? No guarantees, but these safety features give you a lot of extra comfort. So, 5 checks coming up. Number 1, dividend cover. Now, there are 2 ways to do dividend cover. This is literally, as it suggests, how many times is the dividend covered by what? Well, by profits is one way of doing it. So you can take the net profit for the year and compare that to the annual dividend. That's the interim and final dividend. You are looking for, ideally, a minimum of 2 times. All right, that doesn't guarantee anything by itself, but it gives you some comfort that the directors weren't squeezing themselves down to the bone in terms of paying the annual dividend. You know, if they're paying out the entire year's profit or even eating into prior year reserves to come up with a dividend, you've got to ask a question about sustainability. But profits are not perfect. Profits are subject to accounting judgments and so on and so forth. I cover those in other videos. So I would recommend you do it again. Do it from a cash flow perspective. Take the cash flow statement. Now, you'll need to identify something called annual free cash flow. All right, and divide it by the cash dividend paid. And the profit and loss and cash flow figures for dividend are not always the same thing. There's a timing difference there. Now, free cash flow is not something you can just read off the cash flow statement. So a word about that in just a moment, but that will give you additional comfort. All right, you're looking for a decent multiple when it comes to comparing annual free cash flow, 1 year's cash flow, to the cash dividend. Now, free cash flow, I do cover elsewhere, but free cash flow, as a summary, is the operating cash flow. That's heading 1, right at the top of the cash flow statement, minus the capex required to maintain, not expand, the business's current operations. Some people use the depreciation expense as a proxy for that. There's your free cash flow. All right, and you're looking for 2 things. You're looking for a decent level of cover in the year you're doing the examination, and you're looking for consistency going back over time. So, that brings me on to point number 3. Remember, there are 5 checks here. And if this sounds like a lot of homework, well, it's important homework, because at the end of the day, if you're relying on a stock to pay dividends, you've got to be comfortable that it can keep on doing so. So, a steady profit trend over the last 5 years, all right? Ideally, a reasonably steady trend of profit growth. Sporadic profits that jump all over the place, Enron style, for those people who remember that, not a good starting point for a dividend payer. Steady cash flow trend. And again, ideally you want the 2 to be going together. So you want to see a link between the operating profits being generated in the profit and loss account and the operating cash flow being generated in the cash flow statement, so that your dividend cover calculations, which I looked at just now, stack up. Number 3, steady dividend trend. All right, and you can look back over 5 years. You can get this information from websites, all right, and you want to be looking for a nice steady trend in dividends. And a past history of cuts is an obvious red flag. Evidence that management have hit past dividend targets. So what did management promise, say 3 years ago? Did they say we will pay dividends that beat inflation? Have they done that? Fairly obvious question to ask, but a lot of people don't. So how good are management at hitting targets? And that's not just a test for dividends, by the way. It's a test for management in general. Number 4, diversification. No matter how much homework you do, anyone is capable of surprising you. BP was the biggest dividend payer in the market in 2010, slashed its dividend. Tesco was a reliable payer until fairly recently started messing around with its dividend as things have gone a bit pear-shaped on the operations front. So, no matter how much homework you do, you've got to diversify. Don't put all your eggs in one basket. Don't rely on just a tiny handful of stocks for income. That's very risky. Diversify across sectors and types of stock. All right, that way, if one company has a nightmare with its dividend policy one year, hopefully you are to some extent buffered or protected by the other stocks in your portfolio. And finally, balance sheet strength. Now, I recommended a couple of extra bonus videos in the series you could watch. This is going to be fairly fast. What is a balance sheet and 3 balance sheet red flags? But in a nutshell, a strong balance sheet. Now, the balance sheet is arguably the most important of the 3 financial statements. Not the profit and loss account, even not the cash flow, because the balance sheet is the firm's financial position over time. Okay, now, take a look at a few things. There are quite a few things you could look at, but I'll pick out a couple here. Gearing and debt levels. So check out, and I'd cover these in another video, but check out the overall level of debt to equity, all right, and the overall level of interest cover. That is profits before interest compared to the interest expense. What you don't want to see is a firm borrowing in order to fund its dividends. That's a no-no, all right? And equally, even if it's not doing that, high levels of debt, if interest rates start rising, could put pressure on the dividend later. Good working capital management, all right? In other words, a firm that's in control of the relationship between various parts of what I call net current assets, receivables, cash, payables, because that's where dividends are ultimately going to be, that's where the cash from operations is going to pay the dividends is going to be squeezed from, okay? So, as I say, 2 or 3 balance sheet checks that are worth doing, and a couple of other videos I'd point you towards if you found that a bit brief. So in a nutshell, dividend, vital part of your overall investing returns, but don't take anything for granted. The biggest, steadiest stocks in the market can produce a dividend surprise. My 5 safety checks hopefully reduce both the likelihood and the impact